Hello, welcome to Be the Boss of Your Money. This is my live stream where we talk about investing, we talk about money, all things money, we talk about borrowing, we talk about insurance, we talk about the things that you need to learn about to potentially become the best possible version of your financial self. Doesn't that sound great? You want to be a better version of your financial self. We all do. There's a lot to talk about. We focus on investing, the market, the economy, inflation a lot because those feed into almost everything else we do. And then we talk about what to do with this information. So let's talk real quick. The Fed raised rates today for the eighth time, as expected, widely expected, the most widely expected interest rate hike ever in my career to the amount, to the moment it was announced, everything we all expected. And I've been talking about this in the live stream. I talked about this on my radio show this morning. Yeah, I'm still doing the radio show. I didn't stop. I'm just not streaming it because I'm doing it from the LI News Radio studio. And just it's just easier to not stream it on my phone, but I'll probably do it tomorrow because I'm kind of missing sharing all the good stuff with my community right here in social media. You guys are the ones who I know. I feel more comfortable than any place here streaming to you on social media, definitely more so than the radio station because I know who I'm talking to here, and I really appreciate you guys taking the time. It's just more personal here, okay? While you're watching, if you have any questions about what we're talking about or anything about finance, money, etc., please ask me in the comments. I love hearing from you. It's the best part about doing this. If you have, if you want to say hello or just share with me your favorite emoji, that's all good too. Plus, when you comment, helps spread the show to the rest of your contacts. And of course, if you don't mind, leave us a thumbs up. If you're watching on YouTube, please subscribe to my YouTube channel. And certainly make sure you connect with me at Client First Strategy on Facebook. I'm on Twitter. Twitter is Mitch_Goldberg. And I'm Instagram, InstaMitchG. So you can find me in all of these places. So the Fed raises rates, wildly anticipated. I said this morning, this is going to be a non-event. We're already talking about Friday's employment figures. We're talking about the next CPI report. We're talking about the next Fed meeting in the middle of March. Is the Fed going to raise another quarter? The betting is either no more rate hikes, one rate hike, or two rate hikes. I think it's going to be one or two more rate hikes because the Fed has to show backbone and resolve, and it needs to keep inflation low. It would be a shame to piss away all this effort of 8 rate hikes, 450 basis points. It's 4.5 full percentage points in dog years. It would be a shame to waste all that effort and not follow through to get inflation tamped down. We're going to talk about this. Let's roll the intro. Stick around. It's going to be good. We're going to keep a nice, quick pace. And again, if you have any questions, ask me in the comments or just say hello. I love hearing from you. Share with me that smiley emoji. The emoji face with the glasses. That is my spiritual emoji. Definitely share that one. It's always good to see. Here we go. All right, we're back. Thank you so much for joining me. We're just getting started. This is the pod, baby. Money. Be the boss of your money because it's easy for your money to be your boss. It's easy for your money to take control of you instead of you taking control of your money. So we talk about the things here that'll help you take control of your money. Okay. I want to address the rate hike. As expected, the Federal Reserve today raised the federal funds rate by a quarter point. What's the federal funds rate? A lot of people just, it's a short-term rate, federal funds rate. So just so you know, the federal funds rate is not your rate. It's the bank's rate. Banks are borrowing and lending to each other all the time to make sure that they have certain reserve requirements for regulatory capital ratios, okay? So they're always throwing money back and forth, and a bank can borrow from another bank if a bank has excess reserves. Another bank can borrow, and they borrow it on a daily basis. They give it back. They borrow it. They give it back. But when you raise rates, it basically causes the cost of money for banks to rise. So when that happens, banks typically will raise interest rates that they charge you. So if their cost of money goes up, what's the cost of money? The interest rate. That's the cost of the money. If you've ever bought a car or bought a home, you see what it costs, you see what the payments are, and then you look a little further down the contract. It says this is what you will pay in interest during the time of the loan if you pay consistently every month until the loan is completely paid off. All right. That's the cost of money, the interest rate that you pay. The interest rate that the lender charges you, that's their asset, that's their income. That's the money they make on the interest. So you're paying the interest, the lender's getting the interest. So if banks' cost of capital goes up, well, then they're going to raise their cost of capital to you. So it makes borrowing more expensive. It has the effect, it's expected to slow down the economy. It's working. The economy is moderating. But we're not going into this as of now, this crushing death blow. If you recall last week, we talked about the GDP. Earlier this week, we talked about GDP, and last week also we spoke about it, and we talked about the first-time unemployment claims. And you look at these numbers, it doesn't tell you that the U.S. economy is sliding into a deep, horrible recession with massive layoffs. Now, there is a lag effect. We had an awful lot of rate increases in a very short amount of time. So there could be a lag, and we could see the economy roll over in the second half of 23 or in 24. Now, the predictions have been all over the place. All right. The predictions have been all over the place of, we're going to get a recession in the first half of 23. We're going to have a recession in the second half of 23. Then some people say it's going to be pushed back till 24. The fact is, reading the tea leaves, it's starting to look like we're not having a recession. We're not going to have one. Just the labor market is still very strong. I have my own theory on why the labor market is still strong. Okay. It's because so many people have dropped out of the labor market during the pandemic and have not returned. And as our population gets older, we age as a population, there are more people retiring, leaving the labor force. So the remainder of employee age, working age people is shrinking, which means their job security is going up and their pay is going up. I think demographics have a lot to do with this. I don't necessarily think that the Fed is going to change that with the wave of its interest rate wand. I like that. The wave of its magic interest rate wand. Okay. I mean, it is a magic wand. The Fed could print money, they could take money out, they could raise rates, lower rates. It is like a magic wand, isn't it? So anyway, this is how the world works. We're not here to debate if it's good or not. We're just here to say we live in this world and this is how we're going to adapt and be the best we could be. That's what we're talking about. So having said all this, the Fed raises rates. It was a big yawner like we expected. We're already talking about the next meeting and the next labor report. The big non-farm payroll report for January is coming out on Friday. So less than 48 hours, Friday morning, 8:30 a.m. And that's the next big market moving event. It's expected that about 190,000 jobs are created. That's consensus. There are some who say 400,000, 350,000 were created. There are some that say 30,000 were created. So the consensus is 190. So basically, if we see anything more than like 220, 250, 250,000, 230,000 jobs created, that'll spook people to thinking the Fed's going to continue to be aggressive for longer. The Fed said, hey, inflation is moderating, but labor isn't. We're still going to see ongoing increases, and we're going to stay this high for a while. It's everything that people expected. It wasn't worse. And that's why the stock market went up. And it gave the impetus for investors to say, you know what? We think the Fed is very close to the end of its rate hiking cycle. We want to front run this. In other words, even if we know a recession is coming or the economy is going to slow because of the rate increases, we already know that the Fed's going to cut rates. So we're trading way ahead of the curve. That's why the market's moving up. And then there's individual stock stories. The radio show this morning, it's on 103.9 FM, LI News Radio. And if there's something really important that I talk about there, I'm going to talk about it here too. So I realize not all of my social media contacts get that station, although you could listen to it on the LI News Radio app. And I will be posting those on social media, the audio or the video, maybe both. So what we need to focus on is what's coming up, because it's already done. So people are talking about the pivot. Okay, maybe the pivot means when the Fed pauses its interest rate hikes, then it pivots when it starts to cut rates. Pivot! Pivot! You didn't expect that, did you? I have a ton of those little 1 to 2 second clips all over the stream, but so we have to talk about individual stock stories, because there are enough individual stock stories that are starting to become leadership stories. So what we spoke about on the radio show was Boeing, which, because I listened to their CEO on CNBC yesterday, and he basically saying demand is incredibly robust for their airplanes. No end in sight. It just really, business is really good. The MAX jet is back. The world is starving for new, more fuel efficient aircraft. And there's only 2 sellers of this stuff. And the better plane is the MAX jet from Boeing, and everybody wants it. So, and Boeing already has like a new jets coming out already. They've got so many good things coming out. And then there's PACCAR, which is also trading right around its year high. PACCAR makes Peterbilt and Kenworth trucks. So if PACCAR is doing well, truck demand is strong. That's not so bad. That's pretty good. It's expected to get stronger. That's why the stock is going up. Expected to get stronger. But those stocks are, I think, have taken leadership positions in the market. And then we have to talk about the big earnings announcement after the close today. Okay. And that, my friends, is Facebook. Now, Facebook changed their name to Meta because their focus is on the metaverse, of which they're losing a freaking fortune on, but they said they might maybe moderate that a little bit. The point is, Meta is up almost $18 after market. The stock is up, I'm sorry, what am I saying? The stock is up almost 18%. It's up almost 20, it's almost up almost $30 now. Wow. $30 in aftermarket trading, up almost 18%, on top of the almost 3% was up today. So net, it's a 20% gainer between the regular trading today and the aftermarket. Huge move for a company of this size. The stock is doing well. Now, there is some January effect going on here. The worst stocks last year, the worst stuff, from crypto to technology stocks, is performing really well this year. So there's a bit of a January effect. The tax loss selling from last year was pretty heavy. People could finally buy their stuff back because it's February 1st. Everybody is waiting that 30-day wash sale rule. What is the wash sale rule? Just so you know. I don't know why they call it wash sale, but if you sell a stock for a loss, you could use up to $3,000 against your income tax as a deduction. You could also use it against your gains. So if you lose $5,000 capital loss in the stock market and you had $5,000 gain in the stock market, one washes out the other. So but the key is, when you sell a stock for a loss, you have to wait 30 days. So on the 31st calendar day, you could buy the stock back. If you do it before, great, you could buy the stock back whenever you want, but you don't get to claim the tax loss. So if you had $5,000 gain, $5,000 loss, so you'd sell stock for $5,000 loss, and you buy it back a week later, you don't get to write that loss off against the gain. You have to wait. Okay. Excuse me. You have to wait the 30 days. That or otherwise it's called a wash sale violation. Wash sale violation. That's what it's called. I silly name, but well, that's what we've been using, so we're going to keep using it, and we all want to use the same words, so we're all reading from the same page. So let's move on. So Meta, big day. I don't know if this is enough for the stock to take a new leadership role in the market, because not too long ago it was over 200. So is it just a good day? Is it just that it was oversold? There's some short covering going on. That has a lot to do with it, I believe. So we'll see what happens with Meta if it could continue this pace. Their daily and monthly users have remained very steady, so they're not losing people. Their revenues are off 4% year over year, but not nearly as much as people thought they would be. And then you compare that to Snap, which was down 10% today. It's up 10 cents in aftermarket trading. So after losing over 10%, it's up almost 1% aftermarket. That's not really a great improvement. And I think what happened is that, these companies are advertising companies. Facebook has the resources to figure out how to get past the Apple iOS updates to track people, so Facebook could serve them up ads. They've got a lot of work to do in that area. I'm not saying they've solved it, but at least they could invest in that business. They've got the cash flow. And advertisers just like Facebook and Google, and maybe they said, you know what, if we do get into a slowdown, we're probably going to have to cut back our online advertising somewhere. So where do they pull it from? They pull it from second tier social media companies like Snap, maybe from Pinterest also. Pinterest, by the way, reports next week. So that's what's going on. And we will see what the world holds tomorrow. But the futures were down pretty good today, this morning. And like I always say, every morning I start the radio show with the report on the futures. And again, I'll be streaming that here. So the show is for you as well. I don't want to be like, oh, bitch, it's a radio show, not for us. No, the radio show is for you. Okay. You guys here on social media, you're my family. You're the ones who have been with me from the very beginning. But the Dow was down over 300 points earlier today. The futures were indicating a down market. And yet the Dow finished up 6.92 points. That doesn't sound like a lot, barely 7 points. But considering how much the Dow was down, that's a pretty good recovery. NASDAQ had a big day, up over 2%, up over 230 points. S&P up over 1%, up 42 points. Gold went up a little bit. Oil went down a little bit. The 10-year went down a little bit. And the VIX went down to under 18 to 17. So let's take a look at the bond market. All right. Let me get rid of that. Let me get rid of that banner there. Okay. So this is interesting. Yields were pretty much down across the board. Yeah, the 1 month was up a tick, but the yields for the rest of the yield curve were down. So why would yields go down when the Fed raised rates? Well, first of all, the federal funds rate, which is controlled by the Federal Reserve, has a much bigger impact on short-term rates, typically 2 years and under. But what happened is that investors are already anticipating the Fed ending its interest rate hike cycle. They're even anticipating the pivot, when the Fed starts to cut rates. Longer-term bonds are telling you that inflation is going to be under control. We have the 10-year at 3.422. Okay, it was 3.39 at one point today. That's not telling you inflation is going to be persistently high. If it was, then the 10-year should be like 6%, 5.5%, 6%. It should be above the Fed funds rate, which is now 4.75%. So the market is telling you things are looking pretty good right now. And look, we don't know. Maybe in 6 months the market rolls over, the economy rolls over. I do want to say this. We talk about the economy and the stock market like it's interchangeable, but the stock market has new leadership. Remember when we started the pandemic, the market did plunge, real quick over 6 weeks, like a 40% drop in the S&P. By the way, you can't invest directly into an index, but you can invest in a security that tracks your mimics an index. The market dropped real quick, but recovered and then soared to new highs. It was led by those mega cap stocks, the Facebooks, the Amazons, Netflix, Microsoft, Google, Nvidia, the super large ones, okay, Tesla, Visa. If we have new leadership of big companies, those individual stock stories, like what I spoke about earlier in the show, those are the kind of stories that could actually lift the market higher, maybe even to new highs, just because the market has found new leadership. And that, I think, is the most significant takeaway from today's live stream. The stock market seems to have found new leadership. And with that, the generals can lead again and the soldiers could follow. Have a great day, and I will speak to you guys soon. Thanks so much for joining me.